Good day to you. This is Owen McCafferty on behalf of Professional Fusion, just continuing the discussion. The topic area that I'd like to at least throw out is centered in and at liabilities. Liabilities are taken from the Latin word ligare, which means to bind. So a liability really binds your activities, your options, your opportunities, so that you have to be judicious when you decide what liabilities you expect to have and what liabilities you do not. So with that in mind, it's important that we focus in on current and long-term liabilities. Current liabilities would be liabilities that exist and are required to be payable within 1 year. Let's look at some examples. Liability might be accounts payable. I buy things from somebody else and they expect to be paid, usually in accordance with the terms and conditions of the agreement for purchase. So for example, if I buy office supplies, I can buy them directly and I will go to the store, buy them, and they'll expect to be paid right at the checkout counter, either in cash or check or credit card. Now, a credit card is really immediate payment because what we're doing is we're transferring the payment risk from the vendor to a third party. In this case, the credit card company that is really sponsored by a bank. So think of it as an immediate borrowing from the bank. I can also buy, as I would in the old days, office supplies by having an account with a supplier. And I would call the supplier up. I'd either give the supplier a purchase order number, or if I wasn't that big or complex, my name, and request that the office supplier have someone deliver goods to my office. When I received them, I signed off on something. Sometimes, other times it may have just be dropped off, and then I would put it immediately in inventory. There would be at that point an invoice. An invoice would be a bill, in essence, that I have to pay. The terms of that bill could be immediate or could be within 30 days. There will be a statement that will be sent to me, and I have to pay based on the statement. And the terms of the statement might be 210 net 30. In other words, I would immediately owe the money, but I have 10 days to make payment and receive a 2% discount. A net 30 means that if I don't pay for it in 10 days, then I have to pay the full amount. Now you might say, well, gee whiz, that sounds like a pretty good deal. A credit card company will sometimes offer me cents off. Sometimes now the credit card company, if I use them, will have the vendor charging me an additional fee for using that credit card. Depends on the state or the Commonwealth. But in this case, I really do have to worry about the liability that exists. It's current, it's got to be paid based on the terms of the agreement, either within 10 days for a discount or 30 days with no discount. If I don't pay it off in 30 days, then there will be a usurious rate that will be assessed by the credit card company. And depending on what kind of credit cards you have and how much affinity in your credit rating, you could be paying annualized interest of anywhere from 16 to 30% per annum interest on the unpaid balance. Of course, it's measured in terms of days or months, so it doesn't seem like it's that much, but annualized it is. So an example of an account payable, be that from a credit card, which is a third party, or from an actual vendor, which is basically the second party that you've purchased the asset from, is owing and must be paid within a period of time. It can't be stretched out. Now, some credit cards do have a feature for stretching things out further beyond a year. So for example, if you have an American Express Black Card, they will offer you for certain types of purchases an extension of time, of course at a pretty hefty interest rate, an amount. Sometimes the Platinum cards will offer that. So there are long-term features, that is, amounts that can be paid off in over a year on certain types of products that are purchased from certain credit cards by certain credit card holders. Those are short-term. The account payable purchasing from a vendor is an example of a short-term also, but that one isn't as complex and usually has terms that you have to pay for what you've bought once the statement is received within a period of time. So remember the words that I used? I used invoice. That's when I received the good. I'm given a notice that I owe it. And then there's a statement. Most businesses, in this case most practices, pay off statements instead of off invoices. And they always match the invoice to the statement just to make sure that what they allege that you received and what you did receive are the same thing. The word purchase order I use just as a euphemistic trip down memory lane, because probably today most people don't use purchase orders. That's an example of a current liability. Another current liability would be an accrued. Remember in our prior videos we talked about the word accrue means to add from, again, the Latin, as ligare is the root word for obligation or liability. But accrued expenses also are usually payable within a year. And sometimes they're payable within a much shorter time. So from a tax standpoint, if you accrue payroll costs for things like wages or bonuses to people who are not directly related or highly compensated people, you generally have 2.5 months after the year end to make the payment and still have a deduction. Now that's tax law. That's not accounting, but that's tax law. Another example would be things like deferred compensatory arrangements, like a profit sharing plan or a pension plan, where you would have up until the time that you file your return with extensions to make the payment. And again, that's an issue that relates to tax law, but in all instances, they're payable within a year. So that's another example of a current liability. Finally, current liabilities could be measured in terms of the portion of a long-term debt that's payable within a year. Not the interest portion, but the principal portion of a debt. So let's say that I borrow money to purchase equipment over 3 years. I measure what the principal portions of debt are from an amortization schedule, and then I book that as being the current portion of long-term debt. The other portion of the debt owed in years 2 and 3, I would book as long-term debt on that specific liability. So current portion can be based on a current purchase, could be based upon an amount owed as a liability accrued, such as salaries that would be accrued, or could be a current portion of a long-term debt. Those are the most consistent amounts owing. I could really confuse you by talking about accrual-based accounting, generally accepted accounting principles, having the current portion of liability that's being booked and the long-term portion of an income tax liability that's being booked. I don't want to bore you, but what I want to do is just get across the basic idea. So if current portion of debt or current liabilities are debts that are owing in less than a year, then long-term liabilities would be debts that are owing beyond a year. And you'll see right on your balance sheet, even if you have a special purpose framework, financial statement, income tax method, if you have a decent accountant that understands what they're doing, as all CPAs do, at least I sure hope, you'll have a breakdown in the current liabilities and the long-term liabilities. We'll be explaining how all of these liabilities have a bearing in terms of assessment, but for now, that gives you some idea of where things sit. Sorry for looking down at my watch, but the timer that's attached to the camera isn't working, so I have to go old school on this. I've gone a little bit over, but there's a warranted reason why we have to explain liabilities. So remember, go back to your Latin. Accrue means to add. Obligation, liability is taken from the Latin ligare, which means to bind. And we would prepare amortization schedules. And again, from an Italian word, a derivation of Latin, amortia, which means little death. So with that linguistic narrative, this is Owen McCafferty. I'd like to say thank you very much. Appreciate your time. And hopefully we will be talking very soon about another topic of importance. Thank you.